The evolution of banking, from gold certificates to Liberty bonds. Welcome to our video on the fascinating history of banking and the evolution of currency. In this video, we will delve into the concept of fractional reserve banking, the transition from gold certificates to Federal Reserve notes, and the role of Liberty bonds and war savings stamps during a significant period in history. Join us as we explore the intricacies of these topics and gain a deeper understanding of the financial systems that have shaped our world. The issue with fractional reserve banking. Fractional reserve banking is a system that allows banks to hold only a fraction of their depositors' funds as reserves, while lending out the rest. While this practice stimulates economic growth by increasing the availability of credit, it also poses risks. In times of financial instability, a bank run can occur when depositors rush to withdraw their funds, potentially leading to a bank's insolvency. Replacing gold certificates with Federal Reserve notes. Gold certificates were once a common form of currency, representing a specific amount of gold held by the issuing bank. However, as the United States faced economic challenges during the early 20th century, the government sought to stabilize the economy by introducing a more flexible currency system. In 1933, President Franklin D. Roosevelt issued Executive Order 6102, which prohibited the hoarding of gold coins, bullion, and certificates by U.S. citizens. This move aimed to increase the circulation of money and stimulate economic growth. Consequently, gold certificates were gradually phased out, and Federal Reserve notes became the primary form of currency backed by the government's promise to pay. People were still hoarding gold. Despite the transition to Federal Reserve notes, people were still hoarding gold. The government's efforts to encourage spending and investment were hindered by individuals who preferred to hold on to their gold rather than participate in the economy. This hoarding behavior limited the effectiveness of monetary policies aimed at stimulating economic growth. Induced to Liberty bonds and war savings stamps. During times of war, governments often rely on citizens' financial support to fund military operations. In the case of the United States during World War I, Liberty bonds and war savings stamps were introduced as a means to finance the war effort. Liberty bonds were government-issued securities that allowed citizens to lend money to the government. These bonds offered a fixed interest rate and were redeemable after a specific period. War savings stamps, on the other hand, were small denomination stamps that individuals could purchase and collect. These stamps could be redeemed for a higher value at a later date, encouraging citizens to save money and contribute to the war effort. Conclusion. The evolution of banking and currency systems has played a crucial role in shaping our economic landscape. From fractional reserve banking to the replacement of gold certificates with Federal Reserve notes, and the introduction of Liberty bonds and war savings stamps, these developments have aimed to stabilize economies, encourage spending, and finance significant events such as wars. Understanding the historical context and the motivations behind these changes allows us to appreciate the complexities of our financial systems. By learning from the past, we can continue to adapt and improve our banking practices, ensuring a more stable and prosperous future. As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.